This final chapter, Chapter 5, contains 4 short questions to test your understanding of these materials. Question 1. Commodities are considered suitable for institutional portfolios because they have which of the following properties? Here are the 4 permissible answers. Solution to question 1. We saw clearly in Chapter 1 that commodities have generated high returns historically and have proven to have low or negative correlations with other asset classes, but that they are quite volatile both in absolute terms and relative to other asset classes. Therefore, the correct answer is B, as in boy. Question 2. You begin attempting the roll strategy while the curve is in backwardation, and shortly thereafter the curve shifts down and switches to contango, with each point on the curve lower than initially. Which of the following 3 sources will generate gains? Here are the 4 permissible answers. Solution to question 2. The T-bills certainly generate revenue. The shift downward in the curve hurts your strategy, since you will sell at the spot price. The switch to contango also hurts your strategy, since you will sell in the spot market at lower prices than you buy under the forwards. Therefore, the correct answer is A. Question 3. Under a mean reverting model, which of the following statements is true? Here are the 4 permissible answers. Solution to question 3. We mentioned in Chapter 1 that mean reversion may either increase or decrease the price of out-of-the-money options versus their price under geometric Brownian assumptions, depending on whether the mean reversion pulls the price nearer to the strike or further away from it. For example, if the long-term equilibrium price is 100 and a call is struck at 140 while spot is 120, mean reversion is likely to pull the price down, so further away from the strike, and hence reduce the value of the call in comparison to under a geometric Brownian assumption. While if the long-term equilibrium price is again 100 and the call is struck at 140, but spot is 80, mean reversion is likely to pull the price up, so closer towards the strike, and hence to increase the value of the option, again in comparison to under a geometric Brownian assumption. Therefore, the correct answer is C, as in Charles. Question 4. Which of the following is not a factor in the pricing of the structured note quantoed into euros from Chapter 4? Here are the 4 permissible answers. Solution to question 4. The first 3 factors are all important to the pricing of the note and were thus identified in the discussion in Chapter 4. The expected return of the underlying for any option and irrespective of currency is not a factor in the pricing of options. Therefore, the correct answer is D, as in David.